Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. December corn continues to be range-bound with resistance overhead at 353 and support down below at 342.5. We anticipate this market will continue to trade sideways for the next couple of days at the very least, with November 8th being the next release of the USDA WASDE report. Upon release of the WASDE report, we can see a potential breakout, but for now we anticipate that the market will be range-bound with the potential of turning down after the WASDE report. This sideways low volatility movement for corn is consistent for this time of the season, and we can also see from our charts where our volatility bands are coming in, and the market really has grown tighter and tighter, suggesting that this tightness of movement will continue for at least another week. Once the market is able to break outside of our volatility bands, we can potentially see a bit of movement from there. Again, November 8th looks to be the potential date or somewhere near that timeline for when the market may break out of its sideways movement. The March contract is similar in its movement with resistance overhead at 369 and support down below near 357 to 355. We also have an important time factor that happens to coincide with the upcoming USDA report. We have the vertical tangent line coming in against our arc movement, suggesting that somewhere near this November 6th to November 8th, again, looks to be a potential timeline where the market could very well break out of its sideways movement. Beyond the November 6th to November 8th timeline, the next window we would then be looking at is closer to Thanksgiving, coming in at November 20th. What we're seeing from the likes of January beans has been very interesting in that the market has been making subsequent higher highs and higher lows as it has been trading. The most recent low that has posted came in near 980, and from there the market has bounced up slightly. Also, we do have a time factor that did come in near that market low, and we can see after that market posted that low that we have a nice upward movement coming in from there. Over the next couple of days, if the market is able to continue higher through Friday, it is possible then that we could see a movement that goes back up to retest previous highs, although that remains to be seen. Also of key note, we can see that the market has given us a key market sequence of 3 subsequent higher highs. The next time it posts a higher high would be an indication for a potential major correction coming in. And so the way in which the market moves from this point forward is going to be very important to watch, especially over the course of the next 2 weeks. After the major decline that this market posted, its first attempt at a retracement came in very close to the Fibonacci 62% level at 1,006.5. From there, the market gave us a minor correction and looks to be making its way back up again. We also have a time factor coming in near November 3rd. And so in the event that the market comes up into this November 3rd timeline and fails to eclipse the previous high, from there the market could start to turn down. On the flip side, if the market's able to post a strong close above this previous high, a move up to about 1025 and even 1027 is possible before the market finds its next key level of resistance. For now, we'll simply sit on our hands and wait to see whether or not this market is in fact able to break the $10 mark over the next couple of days. December wheat has essentially given us exactly what we've been looking for. The first area of demarcation was the October 26 time factor that posted for us a very key low, a key support at 422.5 to 424. The markets gave us a 2 to 3 day pullback from there and then returned to weakness as anticipated. It found very good resistance up against a point of control level of 441.5. And from there, the market turned down, and now we find ourselves at our minimum price objective of about 416, where the market is still currently testing. If the market continues to find weakness below this level, our original target in the neighborhood of $3.97 to $4 looks to be in play, so we'll continue to watch the way in which wheat continues to trade. Down below, we're looking at about 405 as a potential intermediate area of support where the market could bounce for a day or two. But from there, we anticipate the probability of coming down to the 397 to 400 number is very realistic. The price movement yesterday did trigger an SR level, suggesting that the market could very well bounce or go sideways for a couple of days, but the market continues to look like it has some weakness still ahead. We have key support coming in at the 360-degree mark at 414, but given that the market has been down for the last 5 to 7 trading days, it is due for a potential pause. The price action for the March contract is very similar, but it is important for us to point out that the nature of the movement that we've seen recently is running out of energy, and we're showing some signs of divergence right now. The first major low that the market made back in August has since been eclipsed with the recent low that we've seen, but the strength of the momentum is also decreasing. This is your prototypical divergence movement that we're seeing here. When the market makes a significant low that is eclipsed by the next low, but does it on less strength, that divergence signifies for us the potential for the market to turn back up, and that the low that we're seeing can be a low of significance. If that in fact is the case, it is possible then that a major low for wheat is in play and that a buying opportunity for the long haul may be setting up very soon over the next couple of weeks. From this vantage point, we have a potential target coming in near 424. So over the next 2 weeks, either the market hits 424 or the market hits a time factor near that mid-November timeline. Whichever comes first could end up signaling the major low that we're looking for a move up in wheat. December crude has finally made its way up to our price objective of 54.80, and the market now is hitting up against a double band of volatility-based resistance, and we also have a support resistance band signaling off. From there, what we anticipate then is that this market is potentially strong, and the next corrective pullback, if it stays above the 49 mark, means that this market could very well trade higher. The vantage point that we're seeing right now tells us that we have a small intermediate 5-wave sequence that the market has now posted. Where it terminates is yet to be seen. It's possible the market could have legs and reach somewhere in the neighborhood of 58. But for now, we do have a very clean 5-wave sequence with the potential for a corrective move to the downside with a small ABC if the market is stronger. And with that ABC correction coming in potentially near the 49 mark means that we have another major leg up for crude oil setting up. The alternative is if the market breaks below the 49 or 48 area, that would indicate that this major move to the upside is exhausted, and instead we may see a retest of previous lows. Over the next couple of weeks, we'll be running out of time for this December contract, and we'll soon be moving over to the March contract instead. Weeks ago, we presented the hypothesis that a major low for the US dollar was potentially in play near the $90 mark, that the market could very well make a run up to the $95 area, from which point we were looking for a correction to take place and for the market to then drop back down and perhaps test somewhere in the neighborhood of $88 or so. Since then, the market has made some nice movements. We wanted to present the before and after of those projections as the market is playing out currently. We now fast forward a number of weeks and we see that the market now has, in fact, posted for us the first leg of our projections. Whether or not resistance at this area holds remains to be seen, but it has been impressive to see the way in which the market has been printing in conjunction with what our projections showed. Scaling down to the daily chart versus the weekly chart, we now find that the market moved up to our price objective of $95, hit that number very close to our time factor of October 30th, and from there the market gave us a bit of a correction, although today the market is showing a little bit of strength coming back up again. Our key level then that we'll be looking for is between this $94.62 to $95 mark. And if in fact this market's able to close above this $95 mark, a move up to about 96 and perhaps as high as 96.64 could very well be in the cards for the US dollar. But from here, we're looking at potential short-term resistance, and the way in which the market responds at these levels will be able to give us guidance as to whether or not strength is ahead for us. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.